Today, credit lifts a tad in January. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. As we hit the end of February, on the last working day of the month, we got the latest credit statistics for January 2020 from both APRA and the RBA. First, we'll take a look at the APRA monthly stats, which shows total reported balances for each bank to the end of January 2020. Now, I should say that my industry contacts tell me that the way the data is presented by APRA differs from how they manage and measure their portfolios internally, especially regarding the distinction between investment and owner-occupied loans following APRA's recent revisions. But that said, total balances for home lending for the banks grew by 0.26% in the month to $1.75 trillion, with loans for owner-occupation up 0.38% to $1.1 trillion, and investment loans up 0.04% to $0.64 trillion. Investment loans made up 36.9% of the portfolio. And in fact, there's no change there from last month. Now, these are net balances after repayments and new loans, and refinancing between banks have been taken into account. And the individual movements between banks show that CBA and Macquarie Bank are leading the growth, while NAB and Westpac dropped investment loan balances, ANZ dropped both types, while Suncorp accelerated their investment lending. Macquarie still leads in investment lending. And remember what I said, that some of those statistics are based on the way that APRA has interpreted the information from the banks, and the banks may themselves have a different basis of reporting. But all this suggests ongoing weakness in credit growth. But clearly, individual lenders are executing different strategies, and the portfolio changes highlight the net impact. But then again, we cannot be sure how much of this is to do with reporting changes. Now, turning to the RBA, the credit aggregates to the end of January 2020 were released today as well. Total credit grew by 0.3% last month, compared with 0.2% in December. This gives an annual rate of 2.5%, compared to 4.2% in January 2019. While that is not very strong, it is the best monthly outcome since October 2018 to 2 decimal places. The annual series shows that owner-occupied housing rose 5.1%, investment housing lending is down 0.3%, and overall housing is 3.1%, up from a low of 3% in November, so hardly stellar. And for 2019, housing growth at 3.1% is a record low for the history of the series, dating right the way back to the 1970s. Business credit rose by 0.5% in January, compared with 0.2% in December, giving an annual rise of 2.8%, compared with a 5% rise a year ago. And this, in fact, was the biggest mover over the month. Now, of course, the monthly series are always noisy, and the RBA seasonally adjusts the results without explanation, so we must take their word for the results. The 3-month rolling series shows a small uptick in investment lending to 0%, while owner-occupied lending was up to 1.4% over the quarter, so weak growth only. Business was a little stronger, and personal credit fell at a slower rate of minus 1.5% over the quarter. The broader credit and money supply metrics show that over the past year, total credit rose at 2.5%, slightly higher than last month, while broad money fell a little to 4.2%. So overall, the credit weakness continues to bite. We will see what the new loan data tells us when it's released in a couple of weeks by the ABS, as the net weak numbers could be masked by larger repayments from households seeking to deleverage in these uncertain times. But of course, also remember that this is all before the virus started to bite. So ahead, my own expectation is that credit lending will ease back as the uncertainty levels continue to rise. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.